Alright, let's just get right into it. You've probably heard the term trading bot thrown around, maybe on YouTube or in some online forum, and it sounds super complicated. But honestly, the idea is pretty simple. Imagine you had a personal assistant who was incredibly fast, never slept, and did exactly what you told them to do every single time, without fail. That's basically what a trading bot is for your investments. It's a computer program designed to buy and sell things like stocks, crypto, other assets on your behalf. You set the rules, and the bot follows them to the letter. It's not some magic money printing machine, but it is a powerful tool. Think of it this way. It's more like a very obedient and extremely fast employee that works for you around the clock. You are still the boss, you are still the one making the strategy, and you are still the one setting the rules of the game. So why are so many people from beginners to seasoned pros starting to use these trading bots? The number one reason, and this is a big one, is time. Let's be real. Most of us have jobs, families, and a whole list of things to do that don't involve staring at candlestick charts for 8 hours straight. The market, especially something like cryptocurrency, never closes. It's running 24/7, all around the world. It's literally impossible for a human to keep up with every single opportunity. A bot, however, doesn't need to sleep, eat, or take bathroom breaks. It can monitor the markets in New York, London, Tokyo all at the same time, without ever getting tired. This automation brings an incredible amount of convenience. It means you can participate in the market even when you're asleep or on vacation. Imagine setting up your bot with a solid strategy, and then waking up in the morning to see that it has made a few small, profitable trades overnight while you were dreaming. That's the power we're talking about. It allows you to step away from the keyboard and live your life, knowing your investment strategy is still being executed. Another huge benefit is the speed of execution. In trading, a fraction of a second can be the difference between making a profit and taking a loss. By the time you see a price movement, log into your exchange, type in the order details, and click buy or sell, the opportunity might have already vanished. A trading bot, on the other hand, is connected directly to the exchange's data feed. It can react to price changes in milliseconds, executing trades almost instantaneously. And finally, let's talk about the biggest enemy of almost every investor: emotion, fear, greed. Bots don't have emotions. They are cold, calculating machines that stick to the plan no matter what, enforcing discipline and helping prevent costly, emotion-driven mistakes. It's easy to think of these bots as some kind of black box, but how they actually work is based on a very simple concept: rules. A trading bot does nothing more and nothing less than follow the specific instructions you give it. This is often called rule-based trading. You, the user, define the conditions under which the bot should buy or sell an asset. These rules are usually based on technical indicators, which are mathematical calculations derived from price, volume, and other metrics. For example, a common strategy uses moving averages. You could tell your bot, watch the 50-day and the 200-day moving average. If the shorter-term 50-day crosses above the 200-day, that's a golden cross, buy. If it crosses below, that's a death cross, sell. The bot doesn't know what a golden cross is, it just sees one line cross another and executes. These rules can be as simple or as complex as you want them to be. For instance, buy this crypto only if the RSI is below 30. The price is above the 200-day moving average, and trading volume has increased by 20% in the last hour. By layering these conditions, you can create a more robust strategy that filters out market noise. The bot's intelligence reflects the quality of your rules. It takes in a constant stream of data, price, volume, and more, and continuously checks that data against your rules. The instant conditions are met, it sends an order. It's relentless. If this, then that. The bot's success or failure isn't on the bot itself, but on the strength and logic of the strategy it's told to execute. This is the million-dollar question, isn't it? If you use a trading bot, are you guaranteed to make money? The simple, honest answer is absolutely not. There is no such thing as a bot that is 100% accurate. Anyone who tells you otherwise is probably trying to sell you something. The accuracy depends on the strategy it's running and the market conditions at that time. A strategy can work brilliantly in an uptrend, perform terribly in a sideways market, and fail in a crash. There is no single best strategy that works all the time. Think of a trading bot like a specialized tool. A hammer is perfect for driving nails. It's useless for cutting wood. A trend-following bot will do well when there are clear trends. It will buy when price starts going up and sell when it starts going down. In a choppy market, it can get whipsawed, buying high and selling low repeatedly. Accuracy isn't about predicting the future. It's about probability and risk management. A good bot might only be right 50% of the time, or 60. The key is that winners make more than losers lose. Example, cut losses at 2%, let winners run to 8. With that, you only need to win 1 out of 4 to break even. Win half and you're ahead. Improve performance through backtesting, test against 1 year, 5 years, to refine rules. No bot is perfectly accurate, but a well-designed, thoroughly tested strategy can tilt the odds in your favor. I know a guy, let's call him Dave. Dave works a demanding 9-to-5 job as a software engineer and doesn't have time to watch markets all day. He'd see perfect trading chances on his lunch break, but they'd be gone by the time he got home. He started using a simple grid trading bot. It places a grid of orders, buy orders, and sell orders above and below the current price. It automatically buys the dips and sells the rips within a set range. The bot made dozens of tiny trades daily, each netting maybe $1 or $2. Over weeks and months, it became a supplemental income stream. Then there's Sarah, a long-term investor in traditional stocks. Not into high-frequency trading, she wanted disciplined portfolio management. She used a bot for rebalancing. Her target, 60% stocks and 40% bonds. Each month, market moves would shift that balance. Her bot would automatically sell some stocks and buy bonds at month end to return to 60/40ths. Buy low, sell high, locking profits and accumulating at lower prices. It removed emotion from decisions. Sarah called it the most stress-free way she'd managed investments. She set the rule once and the bot executed monthly, keeping her on track for long-term goals. These stories show that bots aren't just for hyperactive day traders. It's crucial to understand trading bots are not a magic wand for every market situation. They have specific environments where they excel and others where they struggle. The best-case scenario is clear, sustained trends or predictable volatility. A trend-following bot is in its element when price climbs or falls steadily. Ride the trend, exit on reversal. Bots also shine in range-bound markets, consistent resistance above and support below, perfect for grid and mean reversion bots that assume price will revert to its average. In a choppy sideways market, they can systematically scalp small profits, a tedious, time-consuming task for humans. However, bots can get into big trouble during sudden, unexpected market events, black swans like surprise policy moves, major geopolitical crises, or exchange hacks, causing extreme, unpredictable volatility that can shatter a bot's logic. A trend bot might get faked out by a spike. A range bot might see price crash through support and keep falling, racking up losses. Bots can also struggle in low volatility or slow, erratic drifts, few signals, idle orders, or death by 1,000 tiny losses. Understanding best and worst case scenarios is key to knowing when to deploy a bot and when to keep it on the sidelines. So after all of that, we land on the big question. Should you, personally, consider using a trading bot? My honest advice is this: maybe. It really depends on your goals, your personality, and your willingness to learn. A trading bot is not a set-it-and-forget-it path to instant riches. It's a serious tool that requires a solid strategy and ongoing supervision. If you think a bot will print money while you do nothing, you'll be disappointed and likely lose money. That's the reality. If you're considering it, start with education. Learn the basics of trading and technical analysis. Understand moving averages. Understand RSI. Understand risk management principles. Know the strategy you're asking the bot to execute. Using a bot without understanding it is like flying a plane without knowing the controls. Start with a demo account or paper trading. Use platforms' test features to try strategies with fake money in real markets. It's a risk-free way to learn. When you go live, start small, ridiculously small. Use money you'd be okay losing at first. This lets you learn platform behavior without emotional stress. As you gain confidence, slowly increase capital. Discipline and incremental sizing are critical. Trading bots can save time, trade with more discipline, and execute strategies with lightning speed. They're making systematic trading accessible to more people, but they're not a substitute for knowledge. The bot is only as good as its programmer. If you're disciplined and willing to learn, test, and refine, a bot can be a powerful asset. If you want a shortcut, steer clear. There's no free lunch in finance.